recent OPEC Plus decisions when rising tensions in West Asia and its impact on the oil market and the longer-term energy transition play, how do you see the broader oil sector landscape shaping up?
Oil prices are a play of several variables. It's not only supply demand, it is geopoliticals, it is how the interactions are happening between economies, how big is the impact on electric vehicles or the other sustainable fuels on the market, how we are affecting the use of biofuels in our transportation fuel. It depends on so many different things. And as we have seen in last 2 to 3 years, it has varied from maybe $100, $150, $105, $110 to maybe below 60 levels also very recently. And now again, it has gone up to 75, 76, 77 level. So these are dynamic commodities. They will continue to be dynamic. What we can do is we have to calibrate ourselves in a manner, we have to build up our business scenario in such a manner that we are able to sustain our operations, we are able to sustain the profitability in our balance sheets, we are able to provide fuels to the consumers at all times when which is affordable, which is available, and which is sustainable. So this is our understanding of the price levels in the energy market.
Mr. Sahney, my next question is exactly on that, because India is seen to be diversifying its sources of oil procurement. OMC starting buying more oil from Russia post-COVID. How has discounted the Russian oil aided the margins for the industry? If you can give us some sense there. And is the share of oil bought from Russia expected to rise further going ahead?
No, actually, we have to understand that when before Ukraine, we have to understand the logic with before Ukraine and after Ukraine. Before Ukraine, the share of Russian oil in India was very minuscule. It was less than 1% or so, less than 2% or so. And it rose up to 38, 37%, 39% at the peak of the Ukraine-Russia war. While we were honoring the sanctions, all the companies were honoring the sanctions because the sanctions were not there per se on the Russian oil. It was a price cap, which was put on the Russian oil. So we were honoring the Russian oil cap, and we were transporting the fuel to Indian shores, and all the oil companies were doing so, which still continues to a certain extent, and it will continue to a certain extent going forward also. It is not a very significant development that it is going to bring out a sea change in how companies are operating, or how the profitabilities are changing, or how the operations are changing, or how the whole oil and gas business in India is changing. It is not going to be a sea change. It has not been a sea change. It is practically coming to sourcing energy, sourcing crude oil from areas or from geographies or from companies which give me profitability, which are in the bracket of giving me the best possible returns on my dollars that we are spending. That is the only criteria that we are following, and that is the only criteria that any oil and gas player in this country will continue to follow.
And Mr. Sahney, global crude prices have seen a sharp uptick recently. If you could help us with some numbers here, how is that expected to impact IOCL's refining margins and overall profitability? What's your guidance for your GRMs for FY26?
2-3 questions. First is a recent spike, that is in one day it rose by 10 to 12%, and then it subsided also. So we should not be reading too much into these sudden spikes. If this trend holds, then maybe we will have to take certain decisions. Yeah, it goes without saying, with higher crude oil prices, the profitability is going to be affected. But at the same time, we are not very sure that these kind of prices will continue or they will go even further. We have a very strong belief that the prices which were holding on in the range of 60 to 70 or maybe 65 to $70, which is a range which we are comfortable with, which India is comfortable with, all the companies in India are comfortable with. It will come down to that level if the things don't go very bad. Today, nobody is seeing the crystal ball, but we only have an assessment that the crude prices are going to subside from the present levels of 74, 75, 76 that today that are hovering around. So in that scenario, we are pretty comfortable below 70 or something. We are very comfortable with the margins which will be available. And if this prices sustain at beyond 75 or 78 or 80 or something, then yes, we will have to do some rethinking.
So for the CGD segment, several geopolitical areas continue to remain EBITDA negative. By when will the full segment run EBITDA positive or turn EBITDA positive?
I can speak of my companies. We have around 45 odd GAs in my companies directly and in some of the JVs that we are there, 2 of them particularly. So all 3 companies, they are having certain GAs, and we target that by this financial year, by end of this financial year, all of my GAs will be turning EBITDA positive. And there is significant growth in terms of CNG, that is the compressed natural gas that is being used for transportation sector and the industrial sector. The PNG is a bit of a laggard. The piped natural gas that is going into the household, replacing the LPG, that is a bit of a laggard, but CNG is doing very well. And at the same time, the industrial natural gas, which we are supplying to our pipelines, they are also doing a very robust business.
And also, Mr. Sahney, the company is planning a capex of 34,000 crores in FY26. What will be this exactly used for, and how much more retail outlooks is the company looking to open up in the next 2 to 3 years?
This 30,000 or 34,000 capex which we are talking about is not only limited to the new fresh plants that we are going to make this year, because we have to understand that in this business, the capex are long drawn capex programs that are happening here. So this is part of a 90,000 crores worth of capex, which Indian Oil has committed for increasing its refining capacity by 20 to 25%. It is part of that. A major portion of it lies there. So in this year, we will be spending around 25-30,000 on those projects, which were the long drawn projects and which we are expecting to get completed by the end of this year, by December 25 or maybe March 26. So most of it will be completed there, and there is some smaller pipeline expansions, some smaller modifications for energy improvement. They form part of the minor portion of that 34,000 crores. So this is the story about the capex. The next one is the retail outlet expansion. We are still doing the retail outlet expansion, which we were last mandated in 22-23, which gave us a mandate for increasing the industry retail outlet by a significant number. It was around 70-80% more than what it was there. So as of now, we as Indian Oil, I can say, is in a very comfortable position. We have for the first time crossed 40,000 retail outlets in India. That is a very significant number to go by out of total 88,000 odd retail outlets that are there in India overall.
Okay, Mr. Sahney, thanks for joining us with your thoughts on that.